We have a blank sheet of paper. Now, the area that we want to talk about now in the remaining time is the WIN supply chain structure. And I'll first of all talk a little bit about the background, and then we'll attempt to draw a picture with respect to this. Now, to continue the, let's say, the situation I was describing a bit earlier, when we say we have a full 100% commonly held group, and it's got one ultimate management. Everybody is marching to the same tune to maximize after-tax earnings for the group so that the share price can be maximized, best returns for the shareholders, good compensation for management, things like that. We're really looking at one managed operation. Let's just draw a circle here. And we know that there will have to be a few functions. We know that there will have to be some R&D for product development. We know that there will have to be some manufacturing. We know that there will have to be some distribution. Now, the top company, which is the public company, is WIN, which is a U.S. company. And you know from entity classification rules and what constitutes a domestic corporation and a foreign corporation, and what the taxability is, the tax base for a domestic corporation, worldwide income. You know that if WIN conducts all these operations itself, it will be taxable in the United States currently. It will not achieve any of the deferral benefit that obviously many companies know and love. So we have this big, commonly managed circle that has these various activities in it. So what are the goals that we might have? Well, we want to defer income. We want to somehow avoid subpart F. We want to put some of our earnings overseas. If we can do that, that's nice. We have deferral. Well, deferral is not so great unless we can also avoid foreign taxes. So we want to minimize taxes in countries that have any income tax, be it low or be it high. We want to at least avoid those as much as possible, because a dollar paid of some foreign tax just reduces the benefit of our deferral. So we've got roughly two objectives: avoid subpart F and avoid foreign country tax. Now, I'm starting out with this blank sheet of paper, drawing a circle, and then putting down these, let's say, basic three functions. There's, of course, more than just those three, but these three major functions. I'm putting them down within this circle because the point is that our legal system allows the fiction of legal entities. We can choose where we put a box. We can choose where that box will be incorporated. We can choose what will happen within that box, what expenses it will incur, what functions it will conduct, what risks it will accept, what assets it will own. This is totally controllable. And unless we really do something really dumb, what we do will be respected by the courts, the IRS, and foreign country tax authorities. That's just the nature of the environment that we're in. So I think starting out with this picture is particularly important, because the whole thing is, when you look at, this fact pattern, this wind supply chain structure, or any of the situations that are within the course fact pattern, you're seeing something that has already been created. And you're then trying to, of course, analyze what the results are. But from a planning perspective, you're always starting out literally with a blank page. Now, you go to a new client you've never been to before, and of course he's got a corporation here and a corporation there, and there's, in a sense, a legacy of what's already there. You really don't, in that situation, have a blank page. But if your client is getting into a new business, or is going to operate in a new country that he's never been in before, there really is a blank page. And if you have legacy companies and arrangements, well, there's nothing that says you can't change those. Well, yeah, there may be consequences to changing things, and that's part of the process. But there's nothing that says that what you've created and that's been there for 50 years can't be changed. You may need a good business reason to change it for it to be respected. There may be a toll charge or cost, in a sense, of making the change. If you're transferring assets from one company to another because it'll be better in the future, then yeah, maybe you have to value those assets and pay a tax on the gain for moving those assets. But you still have a great ability to think of this as a blank page and to draw whatever you want and put whatever you want in the appropriate places.